Welcome to the Retirement Wealth Podcast, where we help you navigate the journey to a secure and fulfilling retirement. I'm really excited about today's episode because we're diving into a topic that's on a lot of people's minds: how to achieve financial independence faster.
Absolutely, Emily. It's such an important goal, and it can feel a bit overwhelming at times, right? But we're here to break it down and simplify the path forward.
Exactly. We'll be talking about practical strategies you can implement, common pitfalls to avoid, and how to align your spending and saving with your long-term goals. I mean, who doesn't want to retire a little earlier and enjoy life a bit more?
Right? And it's not just about the numbers. It's about creating a lifestyle that you love. We'll explore ways to maximize your savings, the importance of investing wisely, and even how your mindset plays a role in reaching financial independence.
And let's not forget about the emotional aspects of this journey. It can be stressful to think about the future, but with the right planning, it can also be incredibly empowering.
Yeah, and we'll share some real-life examples and stories that might inspire you to take action.
So whether you're just starting out or you're already in the thick of planning, there's something here for everyone. Let's get into it.
Sounds good, Emily. Let's dive right into some of the foundational steps for achieving that financial independence we all dream about. You know, Emily, as we look at the current landscape, it's becoming increasingly clear why achieving financial independence is more important than ever.
Absolutely, David. With inflation rates lingering higher than many of us have seen in years, it's like you really feel it at the grocery store, right? Those prices are just, skyrocketing.
Exactly, and it's not just groceries. Think about how that affects everything from healthcare to travel plans. If you're planning to retire in the next few years, you want to ensure your retirement savings can withstand those rising costs.
Right, and I think a lot of people underestimate how inflation can eat away at their savings over time.
Yes. I had a couple come in last month. They're in their early 60s, and they told me they were planning to retire in just a couple of years. But when we ran the numbers, their projected expenses, they weren't accounting for inflation as they should have been.
Oh, wow. That's a wake-up call.
For sure, they were thinking, our expenses will stay pretty much the same. But with inflation, even a modest increase can have a huge impact over a 20 or 30-year retirement.
So what did you suggest to them?
Well, we talked about adjusting their retirement timeline slightly, but also emphasizing the importance of diversifying their investments. I mean, it's not just about the stock market anymore. It's about finding ways to protect their purchasing power.
That makes sense. And with all this market volatility we've seen lately, it's even more crucial to have a solid plan in place, right?
Absolutely. A few months ago, a retiree I know shared how nervous he felt watching the market dip. He had a significant portion of his retirement savings in stocks.
That's tough. Market fluctuations can really shake your confidence.
Definitely. But what was interesting is that after we talked, he realized he had options outside of just stocks. We explored some fixed income investments and even looked at annuities that could provide some guaranteed income.
That's a great point. It's all about balance, isn't it?
Exactly. And I think people often overlook the tax implications of their retirement savings too. With potential changes in tax laws, being tax efficient is becoming even more vital.
Right, especially if tax rates rise.
Yes, and I've seen retirees who didn't plan for that end up taking a bigger hit than they anticipated. A client of mine was shocked when he realized how much tax he owed on his Social Security benefits because he didn't account for his other income.
Wow, that's eye-opening. It's so easy to assume everything will remain the same.
Exactly. And speaking of Social Security, the changes happening there, like the adjustments to the benefits formula, it's crucial to keep an eye on those too. They can affect your long-term strategy.
I've heard about those adjustments. It's all about maximizing your benefits, right?
Right, and it's so important to understand when to start taking those benefits. If you take them too early, you might miss out on a significant amount over time.
And those healthcare costs are another huge factor.
Yes, a recent study showed that a couple retiring at 65 could expect to spend over $300,000 on healthcare throughout retirement.
That's staggering.
It really is, and many people don't prepare for that. They think, I have Medicare, but they don't realize the out-of-pocket expenses can add up quickly.
So what's the takeaway for that?
Well, I always tell my clients to include a healthcare cost analysis in their retirement planning. It can help set realistic expectations and avoid surprises down the line.
And then there's the emotional side of financial security.
Exactly. Financial independence isn't just about the numbers. It's about peace of mind. A client once told me that knowing he had a solid financial plan in place was one of the most liberating feelings he'd ever experienced.
That's powerful. It really creates a sense of freedom, doesn't it?
Yes! When you know your finances are secure, it allows you to enjoy your retirement more fully. Travel, spend time with family, pursue hobbies.
And that's what it's all about, right? Living your best life in retirement.
Absolutely. And with current economic trends like the rise of remote work and shifting job markets, we're seeing more people reassess what retirement looks like for them.
Yes, I think that's a huge shift. Many people are considering part-time work or even starting their own businesses in retirement.
Right, and that can be a great way to supplement income while staying engaged, but it's essential to factor that into your overall retirement plan too.
So many moving parts.
Definitely. And that's why having a comprehensive strategy is critical, looking at all aspects of your financial life, from managing market volatility to preparing for healthcare costs.
And legacy planning is another piece of the puzzle, right?
Yes, it's important to think about how you want to pass on your wealth and values to the next generation. It's not just about leaving money, it's about creating a lasting impact.
I love that perspective.
So, with all these factors in play, it's clear that achieving financial independence isn't just a nice-to-have anymore. It's essential for a secure and fulfilling retirement.
And with that, I think we're ready to dive into some core strategies that can help listeners get there faster.
So let's dive into some core strategies that can really help people achieve financial independence faster. One of the first things I always discuss with clients is the importance of tax-advantaged accounts.
Right, those are crucial. I mean, who doesn't want to save on taxes? Can you break down the main types for us?
Absolutely. The most common ones are the 401k, the traditional IRA, and the Roth IRA. With a 401k, you're typically contributing pre-tax dollars, which means your taxable income is lower for that year. Then, when you withdraw in retirement, you pay taxes on those funds.
Got it. So it's like a tax break now, but a tax bill later?
Exactly. And with a traditional IRA, it's pretty similar. But the Roth IRA is a bit different. You contribute after-tax dollars, so you don't get that immediate tax break. However, when you withdraw in retirement, it's tax-free. That's a huge advantage if you expect to be in a higher tax bracket later.
That's interesting. So if someone is young and expects to earn more as they get older, a Roth could be a smart move.
Yes, definitely. It's a great way to lock in your tax rate now, and let's not forget about employer matches with 401ks. If your employer offers a match, that's essentially free money. Always try to contribute enough to get the full match.
Oh, for sure. I'd say that's a must. But what about people who are already retired? How do they manage their withdrawals?
Good question. A popular rule of thumb is the 4% rule. It suggests that if you withdraw about 4% of your retirement savings each year, you can sustain your retirement for about 30 years without running out of money.
So if someone has $1 million saved, that means they could withdraw about $40,000 a year?
Exactly. But it's important to remember that the 4% rule isn't a one-size-fits-all. Market conditions, life expectancy, and personal spending habits all come into play. Some might need to adjust that percentage based on their own situation.
Right, and I imagine that's where different withdrawal strategies come in. What are some alternatives?
One alternative is the bucket strategy. You divide your assets into different buckets based on when you'll need the money. For instance, you might have a short-term bucket for immediate needs, like cash and bonds, and a long-term bucket for growth, like stocks.
That makes sense. You're kind of balancing risk and liquidity, right?
Exactly. The short-term bucket ensures you won't have to sell investments in a down market, while the long-term bucket can ride out the ups and downs of the market.
And what about asset allocation? How should someone think about that as they approach retirement?
It really depends on your risk tolerance and time horizon. A common rule of thumb is the 70-30th rule, meaning 70% in stocks and 30% bonds when you're younger. As you approach retirement, you might shift to a more conservative approach, like 60% bonds and 40% stocks.
So you're reducing your exposure to market volatility as you get closer to needing those funds?
Exactly. And diversification is key here too. you don't want all your eggs in one basket. Having a mix of different asset classes, like real estate, stocks, and bonds, can help cushion against market fluctuations.
Speaking of real estate, how does that fit into the retirement planning picture?
Real estate can be a fantastic asset for retirement. It can provide rental income, which is a great supplement to Social Security or other retirement income. Plus, property values generally appreciate over time, but it does come with its own risks and maintenance costs.
Right? It's not just a passive investment. You have to stay on top of it.
Exactly. And then there are annuities, which are another option for some retirees. They can provide guaranteed income for a certain period or even for life. But you really need to understand the fees and terms before diving in.
Yeah, I've heard they can be complicated. It's important to read the fine print, for sure.
Definitely. A solid understanding can help you avoid any surprises down the line. And speaking of income sources, let's touch on Social Security optimization.
Oh, yes. That can be such a game changer for many retirees.
It can. Timing your Social Security benefits is crucial. If you claim early, you'll get reduced benefits. If you wait until your full retirement age, or even until age 70, your benefits can increase significantly.
So it's like a balancing act between needing the money now versus maximizing those future benefits.
Exactly. And, a lot of folks don't realize that if you're still working and claiming benefits before your full retirement age, your benefits could get reduced based on your earnings.
That's a big one to watch out for.
Yeah, so planning your Social Security strategy should align with your overall retirement plan. It's all about maximizing your income streams while minimizing taxes.
Speaking of taxes, what are some strategies to save on taxes in retirement?
Great question. One strategy is to consider your withdrawal order. For example, it might make sense to withdraw from taxable accounts first, then tax-deferred accounts, and finally tax-free accounts like Roth IRAs. This way, you can manage your taxable income better and potentially stay in a lower tax bracket.
That's smart.
And don't forget about required minimum distributions, or RMDs, for traditional IRAs and 401ks. You must start taking withdrawals by age 73 now, or you'll face hefty penalties.
Wow, that's an important deadline to keep in mind.
Yes, it can sneak up on you if you're not careful. And finally, just to wrap this up, remember that diversification isn't just about asset classes. It's also about tax diversification. Having a mix of taxable, tax-deferred, and tax-free accounts can provide you with flexibility in retirement.
So many factors to consider. It sounds like a solid plan can really make a difference in achieving financial independence.
Absolutely, but it's important to be aware of common pitfalls as well.
Let's transition into that next. What are some of the biggest mistakes people make when planning for retirement?
So, Emily, one of the most common pitfalls we see is the sequence of returns risk. It's a bit of a mouthful, but it basically means that if you encounter a downturn in the market, when you start withdrawing from your retirement accounts, it can have a huge impact on your long-term savings.
Right, that makes sense. I mean, if you're taking money out during a market dip, it's like digging a hole that's just getting deeper, isn't it?
Exactly. I had a client, let's call him Tom. He retired in 2008, right when the market took a nosedive. He had a solid retirement plan, but he hadn't accounted for the fact that he'd need to withdraw funds during a downturn. His portfolio took a significant hit, and it really set him back.
Oh wow, that's tough. So what did he end up doing?
Well, he had to go back to work part-time, just to make ends meet. It was a tough lesson, but it showed him and me that it's crucial to have a strategy that considers market fluctuations, especially early in retirement.
Yeah, I can imagine that would be really stressful. What can people do to protect themselves from that kind of risk?
One strategy is to have a cash reserve or a bond allocation that can cover your expenses for the first several years of retirement. This way, you're not forced to sell stocks in a down market. Having a diversified portfolio can also help smooth out those bumps.
That makes sense. And then there's taxes, right? I think a lot of folks forget about the tax implications when withdrawing from their retirement accounts.
Absolutely. Many retirees overlook how taxes can impact their withdrawals. For instance, if you withdraw too much from a tax-deferred account like an IRA, you could push yourself into a higher tax bracket.
I've heard stories about that. Like, there's this couple, let's call them the Johnsons. They were so focused on enjoying their retirement that they didn't think about how their withdrawals would affect their tax situation.
Right, and they ended up with a hefty tax bill because they pulled out more than they needed to. It surprised them, and they had to adjust their lifestyle to manage the tax hit.
That must have been a wake-up call. So what should they have done differently?
They should have worked with a financial advisor to map out a withdrawal strategy that considers tax implications. It's all about being proactive rather than reactive, you know? Planning ahead can save a lot of headaches down the line.
And speaking of planning, what about healthcare costs? I think that's another area people seriously underestimate.
Definitely. Healthcare costs can be a significant drain on retirement savings. I've seen cases where people didn't account for things like long-term care, and it really derailed their plans. Take the example of a retiree named Mike. He thought Medicare would cover everything, but he quickly learned about gaps in coverage.
Oh no, that's not good. What kind of gaps are we talking about?
Well, he ended up needing some home health care, which wasn't covered. He had to tap into his retirement savings, and it was a real struggle. Many people don't realize that healthcare expenses can rise as you age, and it's essential to plan for that.
So what's the takeaway here? How can someone prepare for those unexpected healthcare costs?
The best approach is to research long-term care insurance options early on. It's also smart to have a health savings account, HSA. If you have a high-deductible plan, it can help cover those out-of-pocket expenses without derailing your retirement funds.
That's really helpful. Now, another common mistake I hear about is poor asset allocation. Can you touch on that?
Sure. Asset allocation is crucial because it determines how much risk you're taking on. Some retirees stick to too conservative an allocation, thinking it'll protect their savings, but that can actually hinder growth.
Right. I guess that's a balancing act. If you're too conservative, you might not keep up with inflation.
Exactly. I had a couple, the Smiths, who were really risk-averse. They put all their money in bonds and cash, thinking it was the safest route. But over time, inflation eroded their purchasing power, and they found themselves struggling to maintain their lifestyle.
That's such a tough spot to be in. How do you find that balance then?
It's about understanding your risk tolerance and time horizon. A diversified portfolio that includes a mix of stocks and bonds can help. Regularly reviewing and adjusting your allocation as you age is also key.
And what about Social Security? I know that's a big decision for a lot of folks.
Yes, claiming Social Security too early is another common mistake. Many people rush to claim benefits at age 62 without realizing the long-term impact on their monthly payments.
Right. I mean, if you wait, your benefits can increase significantly, right?
Exactly. I had a client named Linda who claimed at 62 because she wanted to enjoy her retirement right away. But she didn't factor in that delaying her benefits could have provided her with a much larger monthly income, especially as she lived into her 90s.
Wow, that's a big difference. So what would you recommend for someone trying to decide when to claim?
It's really important to evaluate your financial situation and consider factors like your health, your need for income, and whether you have other sources of retirement income. Consulting with a financial planner can be invaluable in making that decision.
These are all such important points, David. It really highlights the need for a solid plan and the awareness of these common pitfalls.
Exactly, and even if you've made mistakes in the past, there's always a way to adjust your plan moving forward. The key is to stay informed and be proactive in your retirement planning.
So what are some next steps for listeners to take to avoid these pitfalls?
Well, I'd suggest starting with a comprehensive review of your retirement plan. Look at your withdrawal strategy, asset allocation, and consider your healthcare needs. And don't hesitate to reach out for professional guidance if you feel uncertain.
Absolutely. It's all about being prepared and adapting to those changes. Thanks for sharing these insights, David.
My pleasure, Emily. It's essential to empower people with the knowledge they need to enjoy a fulfilling retirement. All right, so let's dive into some immediate steps that listeners can take right now to help accelerate their journey to financial independence.
Yeah, definitely. I think one of the first things people can do is to check their current retirement accounts. You know, understanding what you've got is so important.
Absolutely. So I recommend using tools like Vanguard, Fidelity, or Schwab. They all have great retirement calculators that can help you project how much you'll need to save based on your current situation.
Right. And those calculators can really give you a clearer picture, especially when you input different scenarios, like changing your retirement age or adjusting your savings rate.
Exactly. And if you haven't already, I think it's a good idea to create an account on ssa.gov. You can access your Social Security statement there, which is super helpful for planning.
Oh, for sure. Knowing your estimated benefits can really help you gauge how much you might need to save on your own. And speaking of savings, what about tax software?
Great point. Tax software can be a fantastic tool for understanding your tax situation, especially as it relates to retirement accounts. You know, things like IRAs and 401ks have different tax implications.
Yeah, and that can really affect how much you keep versus what you owe, right? It's also a good idea to look into financial planning apps like Mint or Personal Capital. They can help you track your spending and savings in real time.
Exactly. Those apps provide a holistic view of your finances, which can be really motivating. Plus, they often have features to help you set and track financial goals.
Speaking of goals, I think creating small, actionable habits is key. Something as simple as reviewing your portfolio quarterly can make a big difference over time.
Right, and while you're reviewing, why not run some retirement projections? Just tweaking your savings a little bit can lead to big changes down the line.
Totally! And if you find yourself feeling overwhelmed, consider reading some books or listening to podcasts about retirement planning. There's some great content out there.
Yes. Books like The Simple Path to Wealth by J.L. Collins or Your Money or Your Life by Vicki Robin offer really actionable advice. And podcasts like The Mad Fientist dive deep into financial independence strategies.
Those are fantastic suggestions. And remember, it's never too late to start improving your plan. Even small changes can lead to significant results.
Exactly. Just taking one step at a time can help build your confidence and lead to better financial habits.
And keep in mind, it's all about progress, not perfection. So whether you're just starting or looking to optimize your existing plan, there's always room for improvement.
Right. And as you're making these changes, keep an open mind about your future needs and desires. Life can throw curveballs, and being adaptable is crucial.
So true. And speaking of adaptability, as you look at your financial picture, don't forget to periodically revisit your goals. What you want now might change in a few years.
Great reminder. Regularly reassessing your goals can help you stay on track and make necessary adjustments along the way.
And you might discover new opportunities or resources as you do that. The financial landscape is always changing, after all.
Absolutely. Staying informed is key, and it can also help alleviate some of that anxiety about the unknown.
Yeah, knowledge is power. So with these tools in your pocket, you're ready to strengthen your retirement plan. Let's recap what we've covered today.
Well, Emily, as we wrap up, I think it's important to highlight some key takeaways from today's discussion on achieving financial independence faster.
Absolutely, David. One major point was the importance of budgeting. Knowing where your money goes is crucial, right?
Exactly. And another significant takeaway was the power of compound interest. Starting early can really make a difference, even if you're just putting away small amounts.
Right, and we also touched on diversifying investments. Spreading your money across different asset classes helps manage risk and can lead to better returns over time.
And let's not forget about the importance of having a solid emergency fund. It's like a safety net that can help you avoid dipping into your retirement savings for unexpected expenses.
That's such a good point. And finally, we talked about setting clear financial goals. Having specific targets can really motivate you to stay on track.
Well, all of these strategies are essential for building and protecting your retirement wealth. It's about creating a plan that works for you and sticking to it. You know, staying flexible but focused.
Exactly! And remember, it's never too late to start working towards financial independence. Every little step counts.
Absolutely. If you found today's episode helpful, we'd love for you to like, subscribe, and maybe even drop a comment about your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone in your life who's planning for retirement or already there. They might appreciate the insight.
Next time, we'll dive into a topic that's really close to my heart. How to build a legacy for your family.
Yes. It's going to be such an important discussion.
Thanks for joining us today.
We really appreciate you being here. Take care and we'll see you next time.